Aggregate demand curve equation. Y equals C plus I plus G plus N X C equals goods and services for consumption. I equals investment in business plant and equipment. G equals Xelve. Purchases of goods and services equals net exports. A shift in the aggregate demand curve to the right is blank. Expansionary. A shift in the aggregate demand curve to the left is blank. Contractionary. Reduction of taxes doesn't improve consumers' well-being. The increase in current income from a tax cut is offset by higher taxes in the future to pay off the debt. Ricardian equivalence proposition. Causes of expansionary AGG demand shift originating in the asset market. Increases nominal money supply. Prices are stick and short. Real money balances rise. Real interest rate falls in assets, then savings must fall. Investment increase and AGG demand shifts decline in. Money demand reduces real interest rate and raises AGG demand in goods market. Causes of contractionary AGG demand shifts in the asset market. Decline in the nominal money supply. Rise in money demand at each output level. Causes of expansionary AGG demand shift originating in goods market. Decline in saving, increase in investment, increase in Xelve purchases, increase in net exports. Causes of contractionary AGG demand shift originating the goods market. Increase in saving, decrease in investment, decrease in Xelve purchases, decrease in net exports. Total quantity of output that producers are willing to sell at various price levels. Aggregate supply. Levels of output that producers are willing to supply at each price level. Aggregate supply curve. Most economists believe the blank is positively related to general price level. Short-run aggregate supply. New classical view of aggregate supply in short-run misperception theory of general price level. Increases, just increase price if demand for product causes your price level to increase. Production as well. Research by Robert E. Lucas Jr. Relationship between AGG output and price level equals Y asterisk A equals AGG. Output E asterisk equals full employment. Output A equals positive number that indicates by how much output responds when the actual price level is greater than the expected price level. P equals actual price level. P equals expected price. Full employment output. Output produced by full employment of existing factors of production. Keynesian view. Prices are sticky in the short run and don't reflect changes in AGG demand. New Keynesian view. Use characteristics of many real-world markets, rigidity of long-term contracts, and imperfect competition to explain price behavior. Prices will adjust gradually and monopolistically competitive markets. Prices adjust fairly quickly in commodity markets. In a perfectly competitive market, when a seller raises prices slight, he will sell blank. Nothing. In a monopolistically competitive firm, the product price is blank, then the marginal cost firm will sell extra output which will satisfy a level of demand, and firm's output will then rise and fall according to demand. Higher aggregate price level equation. It reminds us that P equals PE plus B. C. P equals AGG price level. K equals fraction of firms with stick prices 1. C equals fraction of firms with flexible prices. C asterisk equals full employment output. E equals output. B equals parameter with a value greater than 0. An increase in the expected price level raises expected costs and leads firms to raise prices. An increase in current output raises the demand for an individual firm's product, so flexible price firms raise their The larger the proportion of firms in the economy with sticky prices, the blank the SRAS curve will be. Flatter. Under the new classical view, the LRAS curve is blank. Vertical at Y asterisk. Under the new classical view, the SRAS curve is blank. Sloping upward. Under the new Keynesian view, the SRAS curve is blank. Sloping upward. Under the new Keynesian view, the LRAS curve is blank. Vertical at Y asterisk. Factors that cause shifts in the SRAS curve under the Keynesian and new classical view. Labor cost, input costs, expected price level. Increases in labor costs cause SRAS to shift blank up and to the left. Decreases in labor costs cause the SRAS to shift blank down and to the right. Shifts in price or availability of raw materials or in production technologies affect production costs in the AGG supply curve. Supply shocks. Positive supply shocks cause the SRAS to shift blank. Down and to the right. Negative supply shocks cause the SRAS to shift blank. Up and to the left. An increase in the expected price level shifts the SRAS blank. Up and to the left. A decrease in the expected price level shifts the SRAS blank. Down and to the right. Two things that cause the full employment level growth. Increases in capital and labor inputs, increases in productivity growth. Five principal sources of change in productivity growth. Energy prices, tech advances, worker training, education, regulation of production. In general, increases and decreases in AGG demand have what kind of effect on the full employment level of output? None, meaning LRAS does not shift in response to AD. Hysteresis. Large negative shifts in AD reduce the full employment level of output. Unemployment rates can then be higher than those associated with the full employment level of output for extended periods of time. Monetary neutrality. Changes in AD affect the price level, but no the output level in the long run. Real business cycle view. Assumes perfect information. The SRAS is also vertical. Changes in AD have not effect on output in short run either. Assumes perfectly flexible prices.